Hi, Kyle. Welcome to Investor Talk. That's my great pleasure to you.
Great. How you doing, Max? Thanks for taking the time to chat with me. I really appreciate it.
Thanks to you for your time. Thank you very much for coming. So, if you want to give an introduction to yourself,
Of course. So I'm a part of MDI Ventures. MDI is the corporate venture arm of Telkom Indonesia. Telkom Indonesia is one of the largest state-owned enterprises and one of the largest conglomerates in Southeast Asia. We do almost everything. We have 35 different subsidiaries that are stretch across the largest telco provider within the region. We do logistics, enterprise software, financial services, healthcare. But we also have a broader mandate with MDI Ventures to support all state-owned enterprises of Indonesia. And there's over 200, and they're the most biggest dominant players across every industry category, whether it's pharmaceuticals, oil and gas, different manufacturing, etc. And so we have about $1 billion under management across 5 different funds. We do everything from incubation all the way to growth stage, and we even have a private equity arm that's not a part of MDI, but within the Telcom group that deals with even later stage. Majority of our focus is on synergy-based investments. How can we take technology companies and bring them within the Telcom group or across the state-owned enterprises with the hopes of being able to be a customer, a partner, a reseller of those companies. My role is I'm based in the United States. I look at everything outside of Southeast Asia for MDI Ventures. I lead or head of U.S. investments, but my geography is not focused just on the U.S. It's global. And we have a very unique in approach to investing. We have our 4 major categories that we look after. One is agriculture, healthcare, logistics, and fintech. But we look at everything outside of that as well. But again, the goal is looking at every single one of these industries and globally and seeing what are the most disruptive companies and how can we either bring that to Indonesia or how can we encourage those companies to grow and we could be that partner that helps them expand to Southeast Asia. So yeah, I hope that gives a quick brief overview. Who is MDI Ventures, my role
absolutely,
within MDI, and our focus areas.
absolutely. I'm very keen to talk about CVC because it's not always the same how the VC and the corporate venture capital invest their money. That's actually pretty different.
Mhm.
And I mean, you gave already a very good overview. Now, how much normally you invest in terms of ticket?
It depends on which fund size. We have a incubation arm that does tens of thousands, hundreds of $1,000 checks to companies, mostly in Indonesia, that we can incubate. We also have a pre-seed stage fund that does 100K to $1 million in check sizes, and that's primarily for Indonesia and Southeast Asia based companies. We have a kind of a Series A, Series B focused fund that is kind of incubating those companies, and that's more of a broader APAC region fund and focusing on capturing those deals. We have a telco focused fund that's very like $1 million check size on average, focused exclusively on telco related companies internationally. We have kind of an evergreen fund, $100 million fund focused on just general synergy that typically writes a check size from 2 to 5 million. And then my primary focus is our growth stage funds, $500 million in size. Our minimum check size that we like to write is around 10 million in size. So we do the whole gamut from earlier stages to the largest and the latest stages. Yeah.
I mean, as you invest all the way from the beginning to the end, and I suppose the more growth stage is where you can start looking outside Indonesia in terms of investments. But what are the top concerns? Where do you find conviction when investing? Because you start so early, so maybe the beginning is the team, and after will be more the product, the company, the stage.
Yeah, some of the earlier stage companies are a little bit more difficult. Uh, to identify what is truly going to be winners and companies that are really going to excel. Our process is we map the entire global industry of all types of companies. And we generally know, especially at the earlier stages within Indonesia and Southeast Asia specifically, what product categories are rising and what may or may not do well. Based on, Indonesia and Southeast Asia is 5 years behind US and Europe and a little bit behind the rest of APAC. And so we've seen a rise in consumer services, in marketplaces. Right now, we're going through a financial services and fintech boom, and we're starting to see some more variations of consumer services. We know where the gaps are within Indonesia, and so that's where our conviction comes from for early stage companies. Late stage is much different.
In late stage is more about performance, I suppose.
So yeah, because we're a corporate venture arm, the primary goal, and again, we're the context that we're coming from is we're the government of Indonesia, and our goal is to really build the nation with the best technology in the world, and also protect the nation and enhance the existing state-owned enterprises. So we have a bias on the synergy standpoint, which is trying to work with only the best companies in the world that are disruptive for their industry, because inevitably that will happen within Indonesia. But a lot of times our sweet spot for late stage companies is identifying, are they good financial return investment? Because we can still partner with companies. We don't have to make an investment. Are they great and are they disruptive for their industry? And is their use case or their product practical for global customers or for the local Southeast Asian market? And typically, if we find those three major verticals fit, then late stage that's a sweet spot we like to play in for late stage investments.
We were just trying to move out from the pandemic. How important is for you face to face? And do you like Zoom calls anyway, any kind of call made online, or do you prefer to meet face to face the founders?
Honestly, a lot of the deal sourcing that we've done for the earlier conversations, Zoom's been great. Honestly, you can meet with so many founders and not have to jump on a plane instantaneously for an introductory meeting. And if the founders are comfortable with that as well, that's fantastic. Typically, for when we get to the latest stages and we're about to sign off on an investment check and make an investment, we like to visit the founders in person, see their office, make sure that it's real, and know that our due diligence checks out the company and the team members that they have and what they're focused on. And more later stages, we like to meet in person. But early introductory, it's fantastic. I mean, I just got off a phone call today with a company from Switzerland in aquaculture. It's harder to meet those types of companies in person. You have to wait for some industry event to happen in whatever region of the world that you're in. You have to connect at the right time. Now you can just jump on a quick phone call and have a good intimate conversation with the company that's not even within your realm of the world,
I mean, the pandemic, if there is a good side, is this one. we have now everything so close, even if it's not close at all. That's great. Yeah, we save so much time. How often do you like to meet the founders after investing? Are you pretty much active?
That's of the company and the relationship that we build. Sometimes especially earlier stages, if there's a lot of synergy with the group, we actually have a dedicated synergy team that almost talks on a monthly basis to companies, especially if we're trying to support them with integrating their products into the government or enterprises or resell. For some companies that are we don't need to be as aggressive with handholding into the enterprise. We have quarterly updates. We're very much a hands-off investor. We're not actively, aggressively trying to take board of directors seats. We're not trying to control what the founder does and does not do, because we're not truly financial only investors. Our primary mandate is to know that, we're collaborating or working together and we can create business together. And if that's on track, whether it's immediate or sometime in the future, it's good for us. That's what we want.
How involved did you get with your portfolio, and how do you add value to them?
Yeah, we typically don't get involved with trying to tell our portfolio companies how to run their day-to-day operations or set the strategy for some of our portfolio. Yes, we sometimes will offer feedback if we think founders are maybe burning too much cash or some expenses may not be in a good fit or they're not growing as fast. We offer feedback, but we try not to take too much a controlling seat. Really, again, most of the focus that we have is, for a lot of the deals that we do work with is connecting them directly with our synergy team, and they have their point of contact and we have our point of contact, and we make sure that their team is working with our business units. Now, how we provide synergy and what that actually means, I mean, we're the largest enterprise within Southeast Asia. Think of the largest telco in your country, combine that with the largest retailer, and then the largest logistics company, plus the largest enterprise software services, plus the largest healthcare clinic network. I mean, we do absolutely everything. So the value that we can provide is quite vast. Sometimes we can introduce millions of customers to our portfolio companies overnight. Sometimes we recently connected one of our portfolio companies to government farms because they do aquaculture services and technology products, and now we rolled out that across the government-owned farms, and now we're their major customer. Sometimes we collaborate. We have some portfolio companies of ours that in an enterprise infrastructure, we own one of the largest data centers within Indonesia. That not only they're actually our customer, but we collaborate and try to synergize in ways that we could support each other in growing business together. So we do, tens of millions of dollars in business with the expectation that we could do hundreds of millions of dollars of business together by introducing each other, our customers to them, their customers to us, to collaborate on launching infrastructure in different areas. I mean, there's lots. It depends on the category. Like in biotech, we are trying to set up local manufacturing facilities for some of the companies that we work with, or integrate some of their products into, the government-owned arms, so that they can connect with farmers much better today. So it's really we have the freedom to pull a lot of levers for our portfolio companies, which is why it's important for our investment team to kind of figure out what is the best company to work with. And when we're really confident in that, then we can really push forward and really influencing the bottom line for most companies that we work with.
Thank you, Kyle. As a CVC, do you co-invest and do you lead in investments?
We locally within Southeast Asia, we do lead a good amount. Abroad, outside of Southeast Asia, we tend to co-invest more often than lead.
What about next rounds? Because maybe having you, as you cover all the line to growth stage, I presume you follow up, but do you introduce for the next round also other investors to the startup you invested in?
Yeah, of course. Of course. We definitely want, we believe in synergy value and valuable investors. And there's a lot of variety of investors that can bring a lot of different things to the table. Sometimes it's a CVC, sometimes it's not. And sometimes it's their industry expertise. So of course, we always try to, especially for our companies that are based in Southeast Asia, we really like to introduce them to international investors because they give them a lot different perspective and new connections. So yeah, we do a mix of everything.
I mean, I really like this next topic when it comes to CVC because I see a pretty much big difference between venture capitalist and corporate venture capital in terms how do you expect your investments to play inside your portfolio. I presume in some extent there will be some interaction between them.
Oh, how startups interact with each other from our portfolio.
Yeah.
Yeah, absolutely. I mean, we have if we think there's a great fit, of course, we'd love them to collaborate. And if they can mutually find success, it's in our best interest because they are our portfolio company. We had telemedicine services and pharmaceutical management tools and solutions and billing solutions that all separate companies collaborating together can share different customer base, clientele, business together, actually integrate their products together, and go after a much bigger ecosystem because each one of them has identified better ways in collaborating with their own customer base. And it's easier to make that connection through them or together as opposed to individually. So, yeah, absolutely. We try to do it all the time. And we also try not to invest in competing products either. So if there's a company that is in asset tracking, and then there's another startup that does asset tracking and fleet management, we try to stay away from it because we don't want to have conflicting portfolio either.
What happens if they fail?
That's part of the business. A lot of companies do fail, and obviously our goal is to not have that happen. But it happens, and we've had portfolio companies that do fail, and we've had portfolio companies that have done very, very, very well for themselves. And that's kind of this weird blend of mixing, traditional venture capital, which is pure capital gains per play, versus CVC. Sometimes we make up for losses through synergy value. We invested 10 million in a company, but that company is paying us $10 million for products that we have. We've already got our investment back in the first year, right? And it doesn't matter really what happens to the company, if they do exit or not exit afterwards. And there's some companies that fall off, and that's kind of why we have multiple stages too. We know majority of the companies at the earlier stages are going to fail. But the ones that kind of stick around, that have been able to grow and foster not only underneath us but by themselves, we can double down on those companies at every stage and make sure that we can kind of fuel their success in their respective industries.
Hey, what's your take on pivoting? During the pandemic, we've been talking about pivoting probably every day. But for what I can see, founders sometimes they consider pivoting like failure. So for them, it's very difficult to pivot a business model, pivot actually a product or service to something different.
I haven't seen it too often, but I have seen companies. We have actually two portfolio companies that have pivoted for the better and some that pivoted for the worse. Typically, pivoting happens when you're not seeing growth or you're not reaching the milestones that you're hoping to hit by the time you reach your next financing round. And you need to figure out, or you're not seeing the product market fit that you'd hoped for. And, we've had some companies, for example, in the healthcare space that, are focused on too specific of a disease state for the region of the world. Great technology, but very, very small market for it. And then they've pivoted and tried to use that technology for broader applications that make their business model a lot more attractive to other investors. And they were able to get more interest from their customer base or hospitals and clinics to work with them. We've had some companies that were hardware businesses and were in like thin client devices. And they realized that hardware devices are hard to sell. And there's a big business in it, but it's also very volatile. And we ran into too much volatility. That company was supposed to go public and then couldn't because of the volatility. And then they had to pivot and refocus on higher margin software sales. That was a big bet. That was really hard, and they almost failed in doing so, in changing up their business model. And they had burned through some cash, and they almost had to restart a product internally from scratch. But now that's put them in a profitable position versus before they were burning through cash. But then we also had some companies that were in the insurance space that thought that they could go after employer market, offering a variety of insurance products. It didn't necessarily work out the way they intended, and burning too much cash. And then all of a sudden they decided that maybe they should try to offer more features or more services or something slightly different. And that just ended up burning more cash and not really getting as much excitement or interest from their end customer. And they tried to pivot, and the pivot didn't work. And now they're kind of a plane that's nosediving. So, it happens. And I think pivoting is a good idea, especially if, you run into those barriers, those types of barriers. And either way, I think for most of the time, you're going to have to pivot, because if you don't, if you don't, you're still going to probably fizzle out or fail. And if you do, there's an opportunity that you might make it work and you could bounce back and become very successful. And there's also a possibility that you could try to pivot and it doesn't work and you still fail. But I think, trying it and going after a pivot versus not, I think is good. It's hard to know when to pivot though. That's also, it's kind of an art. It's hard to know when.
Yeah, the problem is knowing when. It's not that easy. Why do you become an investor?
Why did I become an investor? It was actually on accident. I didn't intend to become an investor. I'm originally from Minnesota, went to school there, worked at some, large Fortune 500 companies out in Minnesota, 3M. And I worked for startups within the Midwest region and worked for an M&A brokerage. So in the finance world, I went to school for finance. I had originally moved to Silicon Valley for the intent of working for, an emerging startup company or emerging tech company. And then what happened was I had met through a friend of a friend, a individual who was starting a venture capital fund, which was a startup in itself. We started with $0 under management. In 2 years, we had $500 million under management, 13 different funds, 6 international offices, and a pretty massive portfolio. So that was a kind of a mix of both worlds. And it matched my degree and background in the work that I've done with kind of what we were focused on, but I still got to participate in the technology world. And obviously from that success that we had at that fund and the knowledge that I built up there, it's easier to carry that and continue to stay in the industry versus leave. So by pure chance, if I didn't take the call and move out to Silicon Valley and join this crazy guy who wanted to start a fund, then probably would have been in, I don't know, agriculture or something else. So,
I mean, when it comes to investing, because I think in any stage you see all metrics, whatever it is. But in the end of the day, you need to decide, okay? And which are the critical points for you that trigger ultimately the decision? Okay, I go and invest in this company, because maybe you can find 3 companies that are similar, and you need to find the difference. What exactly makes you okay? Today is the day. I will.
This is a question that I've tried to answer myself for the last 7, 8 years of my career in venture. When I started in venture, the world felt like, you just get a list of companies that are fundraising in a variety of industries, and then you decide based on a quick amount of due diligence whether or not that's an investment you'd like to make based on what the company promises, the product, et cetera. I don't believe in that model anymore, and we've done something completely different, which is, we're a fund that invests in a lot of industries. I have not had a tremendous amount of experience working in healthcare or industrial or in energy or in all these other categories to truly understand the customer's perspective and what actually makes products valuable. And so we've taken a different approach. And that approach is like immersing ourselves from the customer perspective and the global ecosystem of what founders truly believe is disruptive. And like when I say we map out industries, like I'm not kidding, like this is like long reports of thousands and thousands of companies I've looked at around the world. I look at every single website of what I think are some of the best companies. I try to map out the entire industry. If someone says, what is automotive? I can say automotive is 12 different subcategories that break down into even more subcategories. And here's a representative of where the money flows and what's the most valuable companies and where's the disruption in each at an individual product level, both from a function, feature, and use case standpoint. Once you get to that level of depth, typically you start to see patterns in every industry. You start to understand the needs of the customer. And then you also start to understand the vision that the founder actually has. So we looked at recently the supply chain industry, 2,000 companies globally across a handful of categories. And when you look at all companies at the same time, you get to see kind of how everyone's competing with each other, either directly or indirectly, across different categories. You get to see the vision of how companies are trying to innovate that makes them stand out. And then you also get to see how people are actually executing on that. And that takes a tremendous, this is months of work for every single report that we do. And we've done over, 12 reports so far across a variety of industries. But you kind of see early on, here's an entire industry map. Here's some really impressive companies at a product level, what they're doing differently. And it seems like it makes sense when I compare it to every other categories, and I can understand from a customer's perspective their needs because I've looked at how everybody's addressed the customer's needs. And then you can kind of see the route that they're taking. And that's kind of the sweet spot now that I've identified. And it's fantastic from a CVC angle because we don't waste our time with companies that may or be okay or mediocre or just cool to look at. We can be very, very selective in saying there's 5,400 agriculture companies that we've looked at. Of that, there are probably 100 that are interesting across 3 different categories, but we really only want to work with 2. Why? Because they meet those 3 things that I said in the beginning: product market fit. There is a financing component that we think that's going to be very disruptive, and there's a return, and they actually can work with our group or in our region because the product is practical for our end customers. That's a long-winded answer to your question, but that's how I've evolved, and that's how when you finish a report and you do your analysis and you talk to the founders that you're interested in, that's where it comes to you, and you're just like, oh, okay, yeah, I'm very, very, very confident. In early days of my venture career, doing just due diligence periodically, I wasn't, I would say, as confident. But every deal that we do now, I'm 100% confident that company is the best in the world. Nobody's better, and they're going to have the best returns, both from synergy perspective and also from an investment perspective.
That's the best way to go.
Yeah.
What is the perfect recipe for a great pitch, if there is any?
The basics are pretty simple. I think a lot of founders get too caught up in fluff, but if they can just quickly describe the most important pieces of the puzzle from every aspect of what founder or investors want that fills their due diligence requirements, that's step 1. And that's like, can you clearly explain your traction and business model? Can you clearly explain the founders and what makes them great, or why you guys are doing this, or why you have the knowledge to do this? Can you clearly explain why there's a product market fit and why there is a market for that and how big that actually is from your perspective? And then clearly explaining the funding that you need to hit the milestones to grow where you want to grow based on what you've seen is possible with the market size that's in front of you. Like that's basic. Everyone should have that. And it doesn't need to be a lengthy slide. That's pretty straightforward. And I think if you can accomplish those things, that's wonderful. Where's the great secret recipe is the founders that truly understand their industry, the founders that do the same type of work that we do, not like they create these long reports, but they get the industry. They know the dynamics. They understand, what works, what doesn't, the competitors that exist, why their product's not as valuable or where they need to be in the true rules of the customers. There's companies that are like, hey, we want to create human resource software that looks nice and can accomplish these things. I'm like, wonderful. There's a million other human resources software companies out there. Like, what makes it seem like you guys understand why you want to take a bet in this space and why you're going to do better than everybody else? And that seems like a simple answer, but at the same time, like, from an investor standpoint, if the founders, talking out of their ass or like they get it, they understand it, they know why they need to start this and where the opportunity is. Whether it's a passion of theirs or they just think there's a lot of money to be made and they want to go after it. So that's the best recipe, truly understanding the product market fit more than anybody else.
Passion and money are pretty different. Anyway, what's a suggestion to founders when approaching a venture capital, how they should approach CVC or VC?
First step, I think, and I think this is great for what you're doing on your platform, is actually understanding whether or not that investor invests within your industry or is actually interested in your industry. Otherwise, it's a waste of your time. If you're talking to an investor that does fintech investments and you are building an aquaculture company, like it's hard to. But it means that you need to know what the investor's already invested into. So if they're already invested in a competing product, they may not be able to work with you anyways. Some do. The other way to approach an investor, I think, is to really be upfront about everything you're trying to go after. I think some of the best, I hate it when founders reach out to me. I don't hate it, but it doesn't go anywhere when founders say, hey, we'd love to chat with you. I don't have time. I'm sorry. I love it when founders say, like, this is who we are. This is our traction. This is what we're going after. And like, this is what we're trying to raise. We do or do not have a term sheet in place, or these are the investors that we're looking at. In 4 sentences, that's all you need. And that's enough to say, okay, I should spend time here and go after this. And a good example of that is, like, we don't invest in augmented reality, or at least that's not our thesis, nor have we ever done a report. But an augmented reality company reached out to us through cold email because they were a network of whatever. Nobody introduced us. It was through cold email. And they did exactly that. They said, this is what we do. This is how impressive we are. Not in a 10-page paragraph, very like short, sweet, to the point. And it caught our attention. And obviously there's like, great, this is and that's the filter. That's what the filter between investors and startups of the conversation is the investor interested? And the best way to get that answer as a founder is to put up the information clearly up front. If the investor is interested, they will talk to you. If they're not interested, then you got to move on to the next investor. And that saves your time, it saves the investor time. And then that's where you're going to find quicker dynamic of who you want to work with. And that's what happened. We actually are now making an investment in an augmented reality company because they caught our attention. We were interested. We had our follow-up conversations, whatever that needed to be, and then did our due diligence and then move forward, which is great. So that's what I would recommend.
That's a very good recommendation. How important is the IP for belonging to the startup for you to invest?
So I think it depends on the industry. If you're more of like a software platform, like enterprise software or like marketplace, consumer service, IP is not that important. It's execution. We're seeing even like in enterprise infrastructure services, some companies have IP, but the real important piece of the puzzle is that they can execute fast and take over the market quickly. And it's kind of hard to push out somebody with a patent in those categories. Like, how are you going to patent the marketplace? But we also have other companies in biotech space, pharmaceuticals, and industrial engineering. And it's really, or like the augmented reality company they talked about, it's actually really important to get patents. Good example, augmented reality company not only needs to patent their technology and their approach so that they're not, Microsoft or Apple doesn't swoop in and spend $1 billion and steal the idea, but you also have to actually patent the manufacturing process of making your headsets, because people can patent that and that can push you out of an ecosystem. That's happened, right? So for more deep tech companies, patents are more important. If you're a biotech company using a specific type of bacteria that can turn a feedstock into a very high value chemical, someone takes that and replicates that, you're out of business pretty quickly, unless that's patented. And so these industry verticals, the deep tech industry verticals, patents are more important because it's a huge risk. You know, if as an investor, I'm sitting here today and I say, okay, if someone blocks you out with IP for your deep technology company, are you wiped out, or does the opportunity just completely get diminished? And if the answer is yes, then yeah, IP is important. If it's on the flip side, if it's saying, hey, do you really need a patent to build an agriculture farmer marketplace? And if someone else builds one, are you going to be completely pushed out of the market? No, the answer is no. So it's not as important. It's not a big risk factor from an investor standpoint.
Let me close with what will be the best and most promising sectors to start a venture for funders in the coming years?
Good question. I think every industry has some really exciting areas to grow in. And also it's regional too, like old industries like that are pretty well advanced in, countries like Europe or US are not as developed as they are in Southeast Asia, Latin America, Middle East, Africa, right? And those are tremendous opportunities, even though they're not new, exciting, sexy technologies. Basic financial services, lending tools, investment products, financial or marketplaces that manage both the fulfillment and wholesale back end. Like those are great for those markets. For more established industries, I every time I do these industry reports, I constantly see somebody iterate off of already what's cool. Like the Shopify today is kind of already being disrupted by the Shopify tomorrow and that exists today, right? They're just still small and they're going after different verticals. So I think there's opportunities everywhere. Where I think there's probably going to be some ridiculous disruption, like where it's almost terrifying, is in industries like biotech and autonomous transportation. Both of them are extremely difficult, which is why you see too much like promises today and nothing really happens, because people have a huge belief that, once make things possible, there's a lot of disruption, which is true. But gradually every day you get closer and closer to that end goal of, can you create life in a cell or like a petri dish? Can you alter completely someone's genetics in a way that can make them healthier, better, change their physical appearance? Can you create autonomous solutions that can basically completely remove the end or human labor? And that happens across fulfillment, that happens within transportation services. That's hard to do today, but a good example, I don't know if anyone's seen the Boston Dynamic robots, where 10 years ago, the robot could barely stand up. And today you have a robot that's doing backflips and parkour and dancing pretty well on 2 feet. And that's in 10-year time frame, right? The same thing's happening within those fields. They're at the stage right now where they're fragmented, robot that can barely walk, but there's a track to get to the end goal of doing some really impressive things. And when that comes to fruition in 10 years, 20 years, 30 years, 50 years, I don't know, that could be really, really crazy things, like never needing to drive a car, never having everlasting life, never having to worry about cancer, never really having to understand how life can actually be created from literally a molecular structure, like how can conscience be connected to the digital ecosystem and change the form of communication and collaboration. Like there's a lot of stuff that kind of is mind-blowing, but it's in the process. Like I said, we're at the earlier stages of it. We don't know how long it's going to take. But if it does happen, it's going to change a lot of how we do our day-to-day life.
Very exciting time coming. Very exciting.
Always.
Kyle, thank you very much for coming to the Investor Talk. It's been a very great pleasure for me. Thank you so much.
Thanks, Max. Max, I appreciate you having me on. Thank you.